everyone. Thank you so much for joining me today. Whether you're joining me on our podcast or our YouTube channel, I am so happy, so pleased to welcome Carol DeMarco with Fairway Independent Mortgage Corporation in Florida. Carol specializes in reverse mortgages, and it's a topic, I think, that often raises a lot of questions for older adults and their families. And I think it is such an important topic for anyone looking to age in place, and also the families of senior parents. Many people have heard the term reverse mortgage, but they're not always sure how it works, or they have misconceptions about it. So Carol works closely with homeowners who are looking for ways to use that equity in their home. That's wonderful, wonderful equity to support their financial stability during retirement. She helps explain how exactly this whole reverse mortgage thing works and what the requirements are and how it may fit into your broader retirement, plan.
Right.
And because housing and finances, especially these days, are such an important part of the aging in place conversation, I'm really looking forward to talking with Carol today about the realities, the myths, the pros, the cons, whatever it is, all about reverse mortgages. So Carol, thank you so much. Welcome to the show. I'm so glad that you're here.
Thank you.
As I said, I really do believe that that topic is so important, and so misunderstood.
I agree 100%. And I'll give you just a little bit about my background. I was in the mortgage industry for 30 years, over 30 years, in regular mortgages and origination. And I retired in 2013 and did a lot of things in between. But about a year ago, I came out of retirement to promote this product only because I know the value of it. I see the market for it. But the need is here now, and it's going to get more and more pervasive as we go forward. So, I kind of know from a mortgage standpoint what I'm looking at. And even from doing forward mortgages, there's so much unknown out there as it is right now anyway. So when you get into this product, it's like, oh my gosh, people don't know anything. And it's an uphill education, but that's what I do. I train. And I've always been an educator, and that's what gets me so excited about this, because there's so many ways to use this product now. So first of all, when we talk about the need for this product, 10,000 people a day turn 62 in the United States. That's a gigantic market that, it's just could use this product in so many different ways.
Right.
And of that population, we have $18 trillion in equity in our homes.
Oh my gosh.
That's sitting there.
Yeah, it's just
nothing
sitting there
for us.
Right.
It's just sitting there, kind of waiting for us to die so we can give it to somebody. Well, maybe as we get older and more educated and more in tune to a longer retirement period with quality of life in it, this product could be perfect for you.
Mm-hmm.
The average retirement plan right now is around $200,000. Now, $200,000 is a lot of money. However, when you talk about $200,000 and we're living, 20, 30 years plus Social Security, hopefully, which, we hope it won't change too much. It's the average age right now is in the 80s. So we've got a long time to live. And we of our ages, and I'm certainly of the age, we've worked our whole lives to get either a low mortgage or no mortgage, and, have something that's really manageable. And in doing that, we're kind of sitting on a bucket of money that we could use. So let's just start with one thing. Let's start with the caretakers that we have, our children, if you will, our spouses. The numbers are just incredible that 61% of us right now care for somebody. And a lot of us are even in the sandwich generation where our children are maybe taking care of us, and then they're taking care of their children. So there's that population in the middle that is growing faster than any other part of the population right now.
I also want to add that because people are living longer, their children are becoming seniors.
Exactly.
Seniors are caring for seniors.
That's
Yeah.
right.
Yeah.
Yeah. And they're having to use oftentimes their retirement
Right.
income to help mom and dad have a quality of life, stay in place, alter the home, build, another house, a guest house by their house, have them multi-generational in their own home. And a lot of them are even still working their own full-time jobs, 40 hours while they're taking care of their children. I mean, their parents for no money, no income there, and it's just so hard on everybody. So
Yeah.
none of us want to become a burden to our children for sure. Another statistic that I find to be just stunning is that 54% of people who have retired have no dedicated retirement income. And so what's going to happen to them?
Did you say
That's from
54?
AARP.
Wait, did you
That's from
say 54%?
54% have no dedicated retirement income. Yep. I know.
Wow.
So, and it says 63 million adults care for their adults and their children and who have medical conditions already. So there's money going out there. So
Wow.
what I want to do with this program, and what I want to do is show people that this bucket of money that's over here in their home is not sacred. We've worked our whole lives to fill up this bucket over here of cash savings that we're going to be taking income out of, hopefully. That we have 401ks or we have investment accounts or something like that we can take money out of. People never think twice about that. They assume that that's what that's going to be used for, and living better in general. But this other bucket over here that we've also worked on equally as hard to pay off the mortgage, and have maybe a free and clear house or a low mortgage, that's not doing anything. It's not even paying for itself. And many people have that mortgage payment coming out of their income that's coming out of this bucket over here of the retirement. So it's kind of a vicious circle that we need to shift. We need to say, okay, this bucket over here that we have worked our whole lives for, to have a free and clear house or a low mortgage, let's look at that. Let's look at that to alter the house, to right size where we live, to have money there for in-home health care, which is so expensive.
Yeah.
So prevalent now,
Yeah.
so needed, and going to be more and more. So let's think about, let's have that house start paying for that. And the other thing that's so huge is that this bucket over here of savings and whatever, it's finite. The equity portion over here, the way that the HECM, which is let me just say this, the HECM is what we'll be referring to is the home equity conversion mortgage.
Okay.
That's the acronym for it. And that is the new and improved name for the new and improved reverse mortgage from years ago.
How is it different from years ago?
Hugely, it is now an FHA insured loan. So you can imagine FHA is going to put so many guardrails on this program now to protect the consumer, because FHA is not stupid. They don't want the houses back. They don't want people losing their homes.
Yeah.
And so there's no way that a person, unless there's one way, they don't pay their taxes or insurance, whether they have a mortgage or they don't have a mortgage. They've got to pay those two things. Assuming that they pay that, they can't outrun their equity. And I'm going to talk about that a lot more later, that protection that's in here. That's the biggest thing. FHA has protection built into this loan now for the consumer and their heirs, by the way, that nobody can get in trouble. All they can do is improve their life. And the way that it's structured, the bulk of it, now there's exceptions in different types of this program, but the basic one that we're going to talk about, that availability cannot outrun your equity. you can't now, you can end up theoretically outrunning the value of your property, but you always, for the rest of your life, will have access to money, whether you outrun the value of your property or not. And that's kind of confusing, but I'm going to explain that a little bit later. But
Okay.
this could be there for the rest of the time you ever live in that house. If it's 20 years, if it's 5 years, you're not going to say, okay, it's done. It's not like a home equity line of credit where after 10 years, it tops out. You can't use it anymore. This one runs forever.
What do you mean it runs forever?
It runs, if you're 65 years old, let's say, and you put a HECM on your property, every month and we make the loan so that you have access to $300,000, let's just say, and you don't use it all because you're just, you may be using it monthly or whatever, then that 300,000 available amount grows every month. They've just worked it into it that it grows every month by the amount that you've paid in interest or haven't paid in interest. It goes up, so you're never going to outrun that.
I see.
It's like a line of credit that grows.
Okay.
Every month. A traditional line of credit does not grow, but the aspect of the HECM that has the home equity line of credit aspect in it, it will always grow. So you're not going to run out of money over here and say, okay, I've had the loan for 10 years. I've got very expensive home equity, in-home healthcare. You're not going to all of a sudden in 10 years not have that anymore. Whereas over here, your savings bucket, you're going to run out of money.
Right.
So it's a win-win from that aspect for sure. So most people today, it says, according to AARP, 58% of people, boomers mostly, they're more concerned about their own quality of life and having a good lifestyle and good health care than they are about leaving their property to their heirs.
Good.
Yeah. So I said earlier, I think that it's always been our parents' goal to have no mortgage, and it was, kind of built into us too. But I think we're getting a little bit more selfish, that we understand maybe taking care of ourselves is a little more important than leaving something to their children, but it also takes the burden off the children.
I like to think of it as being more practical.
There you go. I like that too. That's much nicer. So, the need to, alter your house to make it more livable, to have in-home health care, to do such that, buy another car that's easier to drive, to pay off a mortgage payment. Because in this mortgage, you don't have a payment that's required. And we're going to talk about that in a minute. So that frees up cash flow. Maybe add to the cash flow that you have, because you can take the proceeds from the HECM as a monthly income. So you can just add that to your income. If you have enough equity in your property, maybe you have a small mortgage. Maybe let's pay off that payment and give you extra income per month. I mean, it just makes all the difference in breathing, buying that extra prescription, or going out, that kind of stuff that we are absolutely all facing and may face more, as time goes on. But then there's other things too that people don't think about, and they think, well, this is more selfish. Well, maybe not. How about you want to have a little bit better quality of life? How about if you want to take a trip? How about if you want to pay for your grandchildren's college and you don't want to take it out of your income? How about that? That works too. Moving to another house that maybe is more manageable, that is one story, that is closer to your grandchildren. Well, what if you sell this house over here, instead of taking all of that money to go buy another house, maybe we put the HECM on that property and help you save $100,000. $100,000
on the new property.
Let's just say
on the old property.
Yeah, and let's say you can use it to purchase a property as well.
Are there any limitations on what you can use the HECM money for?
No.
Wow.
You can't gamble. You can't go out and buy stock. They don't want you to do that. I don't know how they'd ever know, but whatever.
Yeah, I know. Wow.
But let's say somebody has a house and they sell it for $400,000, and they want to get closer to their children, and they find something for $400,000. Well, we're going to take this cash, put it over here, and have a free property. Okay, fine. What if we just do a $300,000 down payment take 100,000 of that 400 that we have from our other house, put it in to a savings account, into an income producing. That's a lot of money to put into a retirement account.
Right.
So you're going from one house and tying it up into the other house. Maybe that's not necessary, maybe. Or if you can't find the house next to your children and grandchildren that 400,000 will buy, then let's put a HECM on for 100, use the full 400. Now you got a $500,000 house that maybe will work better for you. So there's all kinds of ways to work it for a purchase, and you don't have a mortgage payment. So that's the whole goal of this. So I think that anyone who's a candidate for this, anyone that has an adequate and equity in their property, and I'm talking about, you know, the HECMs are usually no more than 30 to 40% of the value, and that's part of the protection. You know, so you can't, you know, really end up owing more than the house is worth. You could, but likelihood is not.
Now, if you took out a HECM for 300,000, and when you sold your house or when you passed away, the value of the house dropped down to 100,000.
Right.
But you took out the HECM for 300,000. Do you owe back the remaining two?
No.
No?
That's the biggest difference now that it's FHA, because you buy what's called mortgage insurance. You have to have that in your loan. Okay. Just like a regular FHA loan, every, you know, FHA loan that's ever been written has this mortgage insurance in it. And you have it on the HECM as well. And what that does is, if you get to a point where all borrowers have to move out of the property, go into assisted living or something like that. So this has to be on your primary house. They move into a facility, they pass away. If any of those things happen and the loan amount, the loan balance is higher than the value at that point in time, FHA mortgage insurance pays it off. So there's neither the homeowner nor their heirs ever have to come to the table with money. I think back in the day, they did, but no longer.
But that's what I hear from a lot of people. Oh, no.
I know, and it's no longer true.
I'll lose my house. I'll lose my house. And I'm like,
no, not unless you don't pay your taxes.
Right.
Right, that's anything. I believe that used to happen, but no more, because again, FHA is the protector. Wow. And it's, you know, you buy that insurance, you don't have an option to buy it or not buy it, and it comes out of the proceeds of the loan. You've got to have it, so that if anything like that happens, you know, you just walk away. And here's another thing for the heirs. Let's say that mom and dad pass away. The will gives the property to the kids, to the heirs. But mom and dad have a reverse mortgage and they owe more than the house is worth. Now what? Well, the heirs can still, they don't have to come to the table with any money. They can buy that house for 95% of current day value. So they could still buy the house at 95%, and the whatever's over and above, they just forget about it. So it's the safest loan going, and it can do what no other mortgage can do. And it is, when it comes down to what are we going to do, we got to take care of mom and dad. I've got to take care of a spouse that now maybe is incapacitated. I don't want to put them in a facility yet. I need in-home health care. I need my house altered to make it more feasible for us to live there in our older years. Or we need to buy a house that's more conducive to getting around, you know, some one story or whatever. What do we do now? You know, here's a bucket of money sitting here. Let's use it. Let's see how we can use it. And it's, again, like I said earlier, it's kind of got to be a paradigm shift from the sacred cow that is equity sitting there in your house to using it to facilitate a better quality of life. And again, it doesn't have to be and should never be a loan of last resort. You can set it up ahead of time and never use it. That's what my husband and I have done. We have it so that if, God forbid, one of us has to have in-home health care, or one of us has to go into a facility, the other one won't be left with all of our income drained. You know, and that's kind of a selfish thing to do in a way, even though no one, I think, ever thinks of that consciously, like if I have to go into facility, I don't want my husband to be sitting there with watching the income that we've worked our whole lives, to build up, drain.
Right.
I don't want to pass away and him have nothing but a house, because then that's nice, but it's not gonna, really be what he needs or, deserves to do. So I think there's so much upside to it. The only downside that is in this product at all is each time, and again, let me just explain to you how it works. You qualify for this loan like any other mortgage. It's a little bit easier because there's not credit score requirements. And even if somebody is getting close to foreclosure because they can't afford the mortgage, we can even deal with that, which is amazing. But to eliminate the mortgage payment, and then they can stay in the property. So you go through the loan process, you get approved, you can take your money in any number of ways. You can take, I think, 60% the first year. They don't let you take 100% of it the first year out because there was abusive, there's some senior abuse involved in that years ago. Again, a protection. You can take it as a monthly income. You can take it as whenever you need it, lump sums whenever you need it. You can do a combination of all. So you can do with it what you want to do and structure it the way you want to do. Every month, you are never, ever required to make a mortgage payment. You're just not. But every month, if there's an outstanding balance, nothing's free. So that interest due on the outstanding balance, not the entire amount, but whatever you've taken out, it's the interest is due. So the interest due is added on top of that outstanding balance. So now if you owe 100,000 of the 300, let's say, that after that first month, you have interest due on that 100,000, and that goes on top of the 100,000.
So if you took out $10,000 of the 300,000, then you owe the interest of that $10,000. You have to pay right then, or it gets added to. So then
it's added to the loan amount.
300.
Month after month, year after year. So it grows. So that's where, in about 25 years, yes, the loan balance is going up, but most of the time, over time, real estate goes up too.
Yeah.
Over time, it does. Right. But let's just say it's a downtime, and when both borrowers die or something like that, and it's a downtime, and you've been in it for 25 years, let's just say, then again, whatever's over and above that value at that point in time is forgiven or paid for you by this insurance. The mortgage insurance. I just can't say it strongly enough. You never, ever, ever have to come to the table with money.
So when you took whatever money you take out, be it monthly or whatever, that's considered income. So you're taxed on that.
You are not taxed on it. It's your own money. It's your equity. Okay. So no, you're not taxed on it. No, it does not affect any kind of assistance. Okay. It doesn't increase your income level to hurt you with any kind of assistance you might take. It is strictly your money that you're taking out. Okay. Nobody's letting you use the money, and you have to pay for that, but it doesn't affect anything. It's not income related. It's not taxable. It is not counted into income that would affect anything like that, for other assistance programs.
If you have a mortgage with your home, does it replace your mortgage?
It can. We do have a portion of that program that can go in, like some people got like the 2 or 3% interest rate loans back in the day, and they don't want to get rid of that. There is a second mortgage component. It's a very small amount of the market. Most of the time, if there is a small mortgage on it, we pay it off to eliminate that mortgage payment. So, usually there's either no mortgage or a very low mortgage. Because remember, the rules that FHA has put on is it has to be a low loan to value. It can be like 40, maybe 50, depending upon your age. And the amount you can borrow increases the older you are. Somebody 65 would get a certain percentage of the equity available, and somebody 85 would get more because you're not going to be in the house as long. Right. So the actuarial table say, well, they're not going to be there that long. So, that's a protection that the loan has as well. Another really wonderful, I think, new portion of this is that if, let's say we have a married couple and one of them, the minimum age to get this loan is 62.
Okay.
Now, let's say one of the borrowers is not 62. Well, she's called a non-qualifying spouse, or
Okay.
he. So he under 62 can't be on the mortgage. Okay. Go forward 10 years, 15 years, and the spouse that is on the mortgage passes away. What happens to the spouse that's not on the mortgage? Typically, that mortgage now has to be refinanced. Not with this one. They can stay in the property as long as they want. They can't access more funds, but they can stay in the property as long as they want. And they do not have to make any, the payments. They'll just sit there and take care of itself like it always has. Again, it freezes in time, but they don't have to get out of the house. They don't have to refinance, none of that. So, that's something that used to not happen. I think it's great, and it kind of because there are more age gap marriages that go on now. And so, if one of them passes away, the other one, needs to be able to have the assurance that they can stay in the house and they don't have to make a mortgage payment.
Right. And I mean, the reality is that it's mostly women who are left. The men are usually the ones who pass away first for whatever reason.
That's right.
And women live, I think, an average of 8 to 15 years more. So not only are they going through that emotional issue of grieving, now they don't have to worry about, like you said, losing the house or mortgage payments or whatever.
And this is interesting too. If they do need to continue that, and now they are over 62, we can refinance it for them now. And the qualifications for this mortgage are much lower, much more generous than a traditional mortgage. And they would get now accessing that new equity. And, they don't have to have a mortgage payment. So I think that's certainly a good thing about this mortgage as well. It's good for everybody. And one other thing that I wanted to bring up is that gray divorce.
Oh, yeah.
is the fastest growing segment of divorces now.
It is. You're right.
And usually one spouse comes out somewhat financially challenged. And usually it's probably the wife, not always. And it's, getting less of a divergence here. But let's say she gets the house and wanted the house, happy about having the house and has some income, but then it becomes burdensome to take care of that house. They want to stay in their house. So if they're over 62, maybe we can give her a reverse. She won't have a mortgage payment to take out of her income. It'll be the equity will then be the house will be taking care of her. She can take out additional income and augment what she's got coming in. It won't be taxable, and she'll be able to stay there. So, and she won't be a burden on her children, that nobody wants to be. And it really is a great tool for those going through that or been through that divorce. And the other thing is the income that could be set up to draw out of the HECM can be used to help her qualify for a loan to get the HECM.
Oh,
yeah, because she's got to have capacity to pay the taxes. So it's not a debt to income ratio like most mortgages have.
Right.
But we can actually structure it that way. And we can structure it that the taxes and insurance be taken out of the HECM as well. So this person might not have to pay anything for their house for forever.
So what, besides the age 62, what other qualifications are there? Does the person have to have lived in the house for X number of years, or what other qualifications are?
No.
Just the age?
Just the age, and they have to show from their income, they have to show capacity to pay their taxes and insurance themselves. Even if it's going to be rolled into the loan, they have to have enough income to cover, certain, those kinds of bills for the house. And they couldn't be deep in foreclosure probably. If they're late on their mortgage and they're looking to get into it, this loan is underwritten by human beings, not by machines, which most mortgages are today. So it makes it a little bit more maneuverable, if you will. You still have to verify certain things no doubt about that. But the age is the big thing, and the equity. The equity is huge because you have to have a good amount of equity in your house to get any money out of it. Because if you got a $400,000 house and you owe 300, we're not going to be able to help you. If you owe 100, we could eliminate the mortgage payment very possibly, because that's the lower.
Okay.
If you have no mortgage on it, all the better. We can set it up, to have the cash flow or whatever. I have let me just give you a couple examples. I've got two girlfriends. Both of them are around late 70s. One of them is widowed. She got enough. She bought a townhouse cash. She's got a nice income, but that's what she's got. Nothing fluffy. So she loves to travel. She got a HECM on her townhouse, and now she takes out a little bit of income every month that helps her have that little special bump that she can live and breathe.
Yeah.
And my other girlfriend is the same. She's still married. He does not like to travel. And he said, have at it. So she's got a HECM on the property, and she takes out lump sums when she wants to travel, and she travels a lot. And he's happy with that because he doesn't have to see his retirement going toward her travel, right?
Right.
So, everybody's happy that way. So those are things that people don't think about. But, with your audience, with aging in place and that kind of stuff, it can be the difference between, and I believe this with all my heart, struggling, worrying, suffering, and doing without.
Exactly. Exactly. And one of the issues, that, as an occupational therapist, I worked with patients after something happened, right?
Yeah.
And I get it. I understand, human nature is reactive, not proactive. I get it. But as an OT, we're all, just trained about being proactive. And that's what aging in place is. It's like getting the home to a point where it's safe to prevent anything from happening so that you can stay as independent and in your home for as long as possible. That's
exactly
the end goal.
Exactly.
But one of the issues is, as great many services that are out there and all the amazing tools and gadgets and everything that can be done to do that, all of that costs money.
Yeah. And insurance does not pay for it.
Insurance doesn't pay for it. Medicare doesn't pay for it. Medicaid, nothing. It's almost 99% out of pocket.
Right.
And as you said, what was it? 54%, or what's some great percentage of people just don't have that kind of money.
I think it's 58%.
58, just
no, 54%. Yeah, that's
54% right. saved. It's not there. So how the reverse mortgage, I think, is just such an important part, I think, of this whole aging in place conversation.
I do too.
It's a no-brainer at this point. It really, are there any costs in coming in and getting a reverse mortgage? What is that actual process? If I were to come in to the office to get a reverse mortgage, what happens? Oh, one other question before I forget. Now that the mortgage or whatever is basically a reverse mortgage, does that change anything when I go to do my will, my living will, my end of life stuff?
No, you own the house just like you always have.
Okay, so it's the same.
This mortgage is just a lien on the property like any other mortgage.
Okay. So I walk into the office to get it. What happens? What goes on?
Okay. First of all, if you're interested, we can do a good faith estimate of closing costs. And I'm going to come back to that in just a second. But before we can actually take the application and get that rolling, you have to go through an independent training class that you do online.
Okay.
But HUD set that up too. So it's not somebody trying to sell you a loan or trying to leave out certain things. This is a completely independent person that walks you through it and answers questions. Okay. And I think they're all live. Not live people. Well, I think they are all live people. I don't think it's You don't go on and read questions. I don't believe it's, it's more of a live kind of thing. So it's easier for people of our age to get.
Okay.
So that explains a lot of things to you. But going back to the closing costs, it's not inexpensive. Mortgages in general are not inexpensive, but that you have all of the normal costs that you have for a mortgage. You have an appraisal, you have credit report costs, you have recording fees, you have whatever your state, those are normal. We can't get around this for any mortgage. The two things that are more expensive or appear to be more expensive in this loan is number one, the mortgage insurance. If you get a regular loan, or FHA loan, if your children get it, or if you've ever had it or whatever, it's 2% of the loan amount, and it's added on top of the loan amount in finance for 30 years. So you don't feel it as much.
Okay.
Right?
Okay.
You never see the entire amount anywhere because it's already in the loan amount. You come over to this, you see it because there's no loan amount, but it's 2% that is, it's thousands of dollars. It's expensive. But that's the insurance that you have to protect yourself and protect your heirs, that you don't have to get in trouble. So when you look at that amount and relative to what you're getting and what could happen, you don't need insurance until you need it, right? Any insurance,
Right.
but it's just a requirement that FHA has on it to protect the homeowner.
Okay.
And the second fee is the origination fee to the originator. That I'm in marketing, so it's not me, but to my company, to Fairway.
Okay.
Because number one, we don't get paid anything. With other mortgages, you can get paid from the lender side and whatever. We have to get paid. We are in that fee. We're paying for, underwriting, funding, and servicing, and the use of the person, the loan officer, for years to come, because people are going to have questions. Their heirs will have questions. They get ready to sell the property. You're always, you're kind of on the hook. And the other thing is, would you lend somebody $100,000 knowing you're not going to get paid back for, say, 20 years? Wouldn't you want something up front? Yes, you would. Because you're not going to get paid your interest. You don't get paid it until the thing's paid off.
Right.
So it can be, I think the minimum is 2,500.
Okay.
And I believe the maximum is 6,000.
Okay.
Regardless of the loan amount. So it's not cheap, but you have to, like I heard an analogy the other day that was perfect. You go out and you buy an iPhone, $800, $1,000, whatever. Well, you can go out and buy a flip phone for $80. Just have your phone line on it. You can still get those.
Yeah.
Why do you get the iPhone or the smartphone? You get it because of all it can do for you.
Right.
There's no other phone on the market like it. It's apples and oranges. So you're going to pay that for this. And here you are paying for a mortgage that performs like no other mortgage in the marketplace.
Now, the money to pay for that process can't come out of the reverse mortgage.
Yes,
it can.
Absolutely. Doesn't have to.
Okay.
And 99%
it doesn't have to, of course.
do that.
Yeah.
99% of people do that. You don't have to. You can pay it up front. And by the way, a person can make the mortgage payment.
Oh,
If
yeah.
they want.
Right. If they want to.
Nobody's
Right.
going to do it. But let's say this is possible. There's no prepayment penalty. So let's say you're into this loan for a year and a half, 5 years, 10 years, whatever, and you get an inheritance. Then aunt dies and leaves you money. You can go in and pay that down. You don't have to close it. It's still available to you, so you can maintain that additional income every month.
Yeah.
So it's, you can pay it down, pay it back, borrow it again, all that stuff.
So, yeah, I mean, like, why would anyone not do it?
Two things. They're afraid. Well, and let me just more than two, probably. They've heard exactly what you brought up and great points that you brought up. I'm going to lose my house. I'm going to have to bring money to the table. My kids are not going to get an inheritance.
Yeah.
That's why. All of three of those things, not true. Probably your heirs are even going to have some money at the end of the day. Probably. Most probably.
Yeah. And the reality when it comes to heirs, from what I'm seeing and talking to so many family caregivers and seniors is that they are having to take money out of their pocket and their retirement at this point to help care for their parents, especially when seniors are caring for seniors. So because their parents don't have the money or whatever. So Yeah, I mean, they're already losing anyway now
Exactly.
at this
And
point.
here's
Yeah.
another thing. I've had done this twice. I work with some assisted living facilities here. And you're right. The children were seniors.
Right.
They had no mortgage on their property whatsoever. They want to put mom and dad in this place as $10,000 a month. Oh my goodness.
Yeah.
Now, they don't have to take $10,000 a month to pay for it because parents probably have some income somewhere, use that first. But they put one on their house to help pay for mom and dad. And when mom and dad pass, they'll pay it off because they'll get, there's life insurance or something, they'll pay it off.
Yeah.
So that helps them maintain their lifestyle, maintain their income. So whatever. And the other, I mean, that's that it does cost money to get into it, but that's in your loan amount. It's not
Yeah.
free.
Yeah. It's
So
not as if it has to come out of your pocket.
none of it has to come out of your pocket.
So
You do have to wait. You do have to pay for the training, which I think is $125. I think that's what it is.
Yeah. Yeah, but we were talking about why wouldn't anyone do it? And you mentioned, that the myths, or at
Yeah,
least
the myths.
how it
And
used to be.
you are in fact eroding the equity in your home. There's no question about it, unless you pay it, but not most people are never going to pay it. And you are using the equity in your property. No doubt about it.
Yeah, but you're using it for a good reason. You're not just using it as to go to Las Vegas and
Right.
gamble.
Exactly. And another thing I wanted to throw out here too is your audience, probably a lot of them are, maybe they work for in-home healthcare companies or, that kind of thing. And I have seen a lot of this too, that the in-home healthcare company, they always have people that are trying to help the people figure out how to pay for things.
Yeah.
So they can get the business. Well, this is a
Sure.
great segue too, that they can just refer them over to me. And we can walk them through the process so that they can get that in-home health care.
Exactly.
And so it helps the person, it helps the in-home healthcare company, helps me, all that stuff.
That's why when I speak to other healthcare providers, or anyone working in aging in place or any senior care service, which is really what I want that directory to be, is all of the services available. But I mention it to everyone, when you walk in or when you meet somebody, a patient, client, whatever you call them, you can provide your services, but there's no doubt that patient or client needs more services.
Exactly.
So you should be part of a team of people that you can say, here's 3 other people in this area, 4 other people, to do the ramp, to do the construction, to do the design, whatever it is that's needed. And the reverse, I said, you need to have something in there, at least one person, if not more, that can provide financial, whatever, be it reverse mortgages, be it grants, be it loans, whatever it is that can help that person pay for the things that they need. Because you can tell them, you can have a packet of 50 pages of things that they need, but if they can't pay for it, it's a useless packet.
Right. And I think that's really a good thing about Fairway is that they have somebody like me that, I'm here for information and education. That's what I'm here for. If somebody's interested and they want to, get down to the hard facts and numbers, then my partner comes in. Okay. And he takes, he's the one that does the, the input and, all the numbers crunching. But I think to just have somebody you can just talk to about it,
yes,
I think is invaluable. And it's not that I'm invaluable. I think having a person like me is invaluable.
It is invaluable.
Kind of take the, round off the edges a little bit, and just let them see, okay, well, maybe this will work for me. Maybe, I will have at least 100,000 left for my kids, my heirs. I mean, there's still going to be money there.
Sure.
Well, and the older you are, the harder it is, I think, to pull that trigger. But you know what? Maybe it's not. Maybe as you get older, your kids are successful, they're already retired, and you need this other place to live, or you need to have somebody come in and help you live. Right.
Yeah. I mean, it definitely, having that person to talk it through. It's almost like when people start going through Medicare, the year before they turn 65, I think you start getting all that solicitation. I know I did. Oh my God, every day I got something about.
I know.
And you end up speaking to a Medicare agent or a Medicare broker, and then they can explain everything to you.
Right.
You need that. You need
You do.
that source to,
Yeah.
explain it, because it is so complicated, or it can be. But like we were saying before, with reverse mortgages, a lot of people have that old notion,
Right.
what it used to be or what they thought it used to be.
Mhm.
So what is the difference between the HECM and the HELOC? Is that how it's pronounced?
Oh,
HELOC or HELOC?
the HELOC.
The
Yeah.
HELOC. Okay,
Yeah.
HELOC.
Yeah. That's a home equity line of credit. You get that
Okay,
from
so
the bank.
what?
The
I'm not
difference
familiar with
is,
that.
good question. On the upside, on a HELOC or a line of credit, you can get a lot more loan size, because it'll go almost up to like 80%, something like that, maybe 90% of your value
Okay.
of that time. And you can pay your mortgage off with it if you want, but you won't want to, because the interest rate's always higher than the mortgage. Usually it's adjustable, so it's going to be changing around. And 99% of them stop after 10 years. So you can have and the interest is still due every month that you have to pay. You can't not pay that one. You have to pay.
Okay.
So you can take, monthly income from it, but out of that monthly income that you're taking, or you're paying back in interest, because you have to pay it. So the fact that it ends after 10 years and you could be, maxed out, you have to make the interest payments every month. So, you may be getting something out of it, but you got to give some back every month, whereas the HECM you do not. And, after 10 years, it's done. So I think that's the bigger thing. So there's an advantage is you can get more cash, but you have to pay for it. And it ends after 10 years. And it can be called. I mean, there's always a clause in those loans that it can be called if the market, dumps completely, then they can call them. Now, I've never known when to happen, but it could happen.
It could happen.
So it's easier, but it's more expensive. A HELOC is easier, but it's more expensive in the long run.
So who do you find, what are the majority, who are the majority of clients, the demographic that mostly come in for a reverse mortgage to Fairway Mortgage?
It's mostly two things that we see mostly. Mostly it's couples that come in that want to age in place, and they need in-home health care.
Excellent.
That's the number one.
Excellent.
The number two, which is really surprising to me, are the divorcees, that they need more money. And I'm seeing this, it's huge. And I love that, because you're really helping somebody have, a better health, a better lifestyle.
Right.
Maybe through something that was not their, they didn't want it, whatever. Or maybe they did, and at any cost they wanted it.
Yeah.
But we can help them be better. But the in-home healthcare is probably the biggest thing. And we're seeing more and more purchases come through too, which I'm happy about. And it could be because I really call on realtors and talk to realtors a lot.
Yeah.
Because it helps people maybe get a nicer house, a better location, a more adaptive house. And they don't have to use all of their money,
Yeah.
their cash, to buy it. We can put 100 grand away or something like that. So
Excellent.
really those three, mostly. And the other thing that we see a lot is home improvement, with the knowing that you will need in-home healthcare eventually. But roofs in the state of Florida, where I am, insurance companies will just come in and say, we can't insure you anymore because your roof's 10 years old, or so, something that's ridiculous. And roofs are $20,000-$30,000.
Yeah.
Well, people need that, so let's let that house pay for itself.
Yeah, I lived in Fort Lauderdale for many years, and you're right. Roofs are 20 to 30,000, and you have got to have that. Yeah, well, because of all the storms, it's a big
home improvement, in-home healthcare.
Yeah.
Huge.
I think it's true. Home renovation, absolutely. That made me think that every state is different and every locale is different, but I think more and more people are also families are also moving towards multi-generational living.
Absolutely.
And then that requires, making changes, additions in the home, maybe adding a tiny house in the backyard, or whatever kind of thing.
Yeah.
Because then that is what
It's
can make a
huge.
big difference. Yeah.
Yeah. And
Yeah.
then, if you do a tiny house or something like that, lots of times they have some income that they can help with, on
Yeah.
this. So, it's endless, I think. And that's why, and again, with the population aging and
Yeah.
the needs growing,
Yeah.
and us living longer,
Yeah.
we
I
need a
can,
little help, and we've
yeah.
worked hard to have it. So why
I
not?
mean, it makes total sense to fear running out of money versus dying, sooner. I mean, that's, yeah, especially nowadays when everything is just so up in the air and nobody
Yeah.
knows
Yeah.
what's
Agreed.
happening day to day, even with, people in their 50s and 60s still working. But with AI coming into the picture now, more and more middle management and more jobs are being eliminated.
Mhm.
I mean, I think they're being replaced with other jobs, but when you're in your 50s and 60s, you're
Hard.
not necessarily in that group that's going to learn all of these new
Right.
tools and techniques. So you're caught in the middle there.
Right.
I get it. I mean, I understand. There's a lot that this reverse mortgage can really help with.
Right.
Yeah, I think it should be part of every single person, everybody who does aging in place services of any kind. It should be
Financial
part,
planners,
yeah,
financial planners need to know about it.
absolutely. It should be part of their Rolodex.
Right.
Oh,
Right.
absolutely.
So if any of your audience, I'm sure it's very varied.
Yeah, so my audience is throughout the United States and Canada. So you're in Florida. Can you
I can do
only
all of the
do
United States,
Florida?
but not Canada.
I'm sorry?
I can do every state in the United States, but not Canada.
Not Canada, right? Well, yeah, I didn't expect another country, but every
Yeah.
state. So, and that's true with anywhere. Somebody lives in, if a reverse mortgage company in Nevada, they could do any state because it's national. It's not
Yes.
per state.
Yes.
And it
Yes.
doesn't change per state.
No,
the
because it's an
rules.
FHA loan, just like
It's
anything.
FHA, so it's national.
Right. So if
Until,
if I can, if you get in touch with me, then I can, I'll refer you to people anywhere. My partner, can do it.
do you have to be referred to somebody else or they couldn't do it with you?
Oh, yeah, they could.
Oh,
But I mean, if I need somebody in California
yeah.
or something, it would be somebody with Fairway that, would do it in California.
Oh, I see.
But not necessarily. I mean, we can do it through the computer anywhere.
Oh, yeah.
Yeah.
I know. You can do anything anywhere. You can live on an island and do anything anywhere.
Right. Right.
It's a whole new.
So I'd like, any of your, subscribers or whatever, I'd love to talk to them about their client base.
So how can they contact you? What is your information? And I'll put it also on the
okay.
The
best thing to do is email me, but it's Carol, CAROL .DeMarco, DEMARCO at Fairway, FAIRWAY MC.com. Carol.DeMarco at FairwayMC.com.
Got it. Perfect. Thank you so much, Carol. I learned
I love it. I mean, I talk all day. I came out of retirement because this is important stuff. It is
important. And I think it's so important to keep working. I'm 68. My friends keep asking me, I'll be 68 soon. My friends keep asking me, when are you going to retire? I said, I am retired.
Yeah.
This is it.
Yeah. We do what we want to do now. And that's a great gift. Great.
Exactly. Gift. And there's nothing better than going to bed at night, knowing that you helped this person or that person.
Right.
It's so fulfilling. I just can't imagine doing it any other way.
And we just learned so much. I've learned so much about the senior space since I started doing this, because I go to meetings where, they're, in-home healthcare adjacent groups, and all the people that are there, have something to do with the care of the elderly. I just learned so much. And people that work in that area are just saints. I mean, they're so dedicated. And it's very uplifting to me as well. And you know, I love to go and speak to groups. I love that. You know, that's what I do best is I talk, you know, I can talk forever, as you can tell.
Yeah. Thank you. Thank you. Thank you so much. Stay on the line a little bit. All right, everyone. Thank you very much. I appreciate you listening. And I will have all the information on the podcast, on the store, on the notes, and also on the YouTube channel. It'll be down in the descriptions. But I'm also going to put your information, your contact information on the bottom of the video
Perfect.
as well. And thank you, Carol.